Every 10K per month trader has a moment where everything clicks. Not an indicator, not a new strategy, a shift in the way they think. They stop trading to feel good, they start trading to follow data. They stop chasing wins and dopamine, they start following rules. They stop fearing losses, they start managing risk with clarity. And the moment they become emotionally neutral, that's when the payouts start to come. Today, I'm going to show you the psychology behind that transformation step by step. And really, there are 5 steps that each of these 10K per month traders have and they follow. Firstly, they work on their identity, then their data, then their rules, their risk, and achieving a state of neutrality. And each of these steps are stepping stones, and they're numbered for a particular reason, in that you can't skip one step. Your identity lays your foundation for your data. Your data lays the foundation for your rules. Your rules lay the foundation for your risk management, and all the above allow you to be neutral and stack funding on this foundation so that you can start pulling $10,000 a month in payouts. Skip one of these steps and your foundation will be poor, and you'll find it crumbling down the moment you try to add scaling and funding to your trading processes. Now, the first step, identity. Every trader has this desired identity of being a consistently profitable trader. But what does being a consistently profitable trader actually mean? How many people, how many traders actually question what that really looks like? And what is the reality of being a consistently profitable trader? The easiest way to look at what the reality of being a consistently profitable trader looks like is having a look at your data at the end of sample collection and backtesting. Let's say you have 1 year of data there, you're going to have a series of trades. At the end of that series of trades, you're probably going to maybe have 100 trades, and you're going to have a profitable percentage at the end of that year. Now, those individual trades will be an oscillation between wins and losses. Not every single one of those trades is going to be a win. You're going to have a variation between wins and losses. Your wins are most likely going to be greater than your losses, and slash or your wins are going to show up more frequently than your losses. But on the larger sample space, you're going to have an oscillation between wins and losses. On the individual trade, it may be a loss, it may be a win. On the individual day, it may be a win or it may be a loss. So being a consistently profitable trader over a large sample space encompasses both winning and losing. But there are so many traders that come in with this imposed fantastical identity where they think, without ever questioning, that I am a consistently profitable trader, therefore I have to win every single individual trade. And every trade I take has to be a win. And we impose this one-sided identity and this one-sided fantasy onto the market, when in reality, there's no evidence of that ever being true. The reality of being a consistently profitable trader is that you're going to have both wins and losses. Yet we impose this one-sided fantasy that is never rooted in truth and has no evidence of showing truth onto this two-sided identity of what it truly means to be a consistently profitable trader. So it's wise to question what ideas you hold about being a consistently profitable trader, and to ground that idea and realize that consistently profitable trading encompasses both winning and losing on the individual trade and the individual sample space. But sticking to your edge and sticking to your process and your rules over a large sample space yields an edge where eventually, over the larger sample space, you have a greater win than you do a loss. And that's where profitability comes in. But don't impose this one-sided identity that you have to win every trade, because then that creates unrealistic expectations and a shaky foundation, because now you go into every trade expecting and hoping a win. When you have the inevitable loss, you experience a very painful loss by law of contrast, and now you have all the psychological issues as a result. You want to overtrade, you want to revenge trade, you want to jump straight back into the market to make back losses. You have fear of missing out on wins on each individual trade, so you get into trades when they're not ready, and now you run by emotion. But if you stabilize that identity and you realize that consistent profitable trading on the individual outcome can be either a win or a loss, and you encompass both potential outcomes, you stabilize yourself as a trader. and you enable yourself and you allow yourself to both win and lose on the individual trade in pursuit of sticking to your trading plan. And you want to always question this idea. Are you truly trading to make money? Because if you do, once you have an edge, you realize that you have to stick to your process irrespective of win and loss. But many traders deep down aren't trading to make money. Deep down, they're trading to have the dopamine rush of winning every trade, or being right, or having a sense of justification and validation. And the more addicted you are to that quick hit on the individual trade and that immediate gratifying behavior, you can't actually embrace both winning and losing in pursuit of your edge. Once you stabilize your identity and embrace both sides of consistent profitability, you then want to collect personal data for your strategy. You want to have a good idea of what your strike rate is and what your average risk to reward is. This gives you a lot of data to be able to make some projections and give you an idea of how well you're executing, because you can have a look at your real results relative to your data and your performance of your strategy. And it's also important to see that on individual trades, you will both win and lose, but over a larger sample space, you're going to end up profitable. So it kind of stabilizes you and it makes you not panic when you take a few losses in a row. And then when you put it in context and you broaden your perspective, you realize, you know what, I'm not going to focus on the individual outcome. I'm going to focus on broadening my perspective and judging my results only at the end of a collective sample space, maybe 3 or 6 months. Because to zoom in on the individual trade and judge yourself and get depressed after a loss is foolish, because current losses are compensating and bringing you back down to your edge when you're in a over-elated state. And these losses are necessary to bring you back to your edge, your true edge. And then when you're in a minimized state, these wins are bringing you back up to your true edge, your true return. So it's foolish to get depressed when you take these losses, and it's foolish to get elated when you take these wins, because really what they're doing is they're stabilizing the exaggerations and minimizations in your results to give you a true mean, your true edge. So to get zoomed in onto the individual sample space is foolish. And when you collect data, you can see that. And what I encourage all my traders to do is collect 100 trades of data, and then in green, highlight the ones that are wins in green, highlight the losses in red, and take a zoom out perspective and see the oscillations between the wins and losses. But realize that at the end of all those trades, you're going to end up profitable. And then really put yourself in a visualization exercise where maybe 10 trades happens over 2 weeks. So you have to sit in that loss sometimes for a day or two. And you have to sit in that feeling of being in a loss or being in drawdown for a day or two. And that's okay, because you want to zoom out and put that in context of the larger sample space. So really, data gives you perspective, and it gives you a benchmark of what to aim for, and a benchmark on having realistic expectations over the larger sample space. Then, once you have a balanced identity and data to have certainty in your edge and to have that perspective, you want to put your data into a mechanical rules-based system. And what a mechanical rule-based system allows you to do, or some sort of a trading plan or trading checklist, is it allows you to have a set of rules that enable consistency in your execution. So there could be millions of different types of decisions you make in the market every single day. But a set of rules allows you to stick to your rules that have edge, and it allows you to ensure that you're sticking to your edge over a larger sample space. You're not second guessing, you're not umming and ahhing, you're not letting emotions run your decisions, but you're letting process run your decision. So once you've done your testing and you have your strategy, you want to put it into a trading plan. Now, a trading plan outlines your entry point, it outlines your exit point, and it outlines your risk management. This we will cover next slide, but let's focus in on entry and exit. You want to set a clear set of rules of, I want to see this, this, and this in the market to then enter into the market. And then I want to see this, this, and this to either trail my stop or take profit or take a loss. Okay, I want to enter. Once I see these criteria, then I'm putting my stop loss here initially, I'm putting my take profit here initially, or I am not putting a take profit on and I'm trailing my stop loss down. You want to get clear on your rules-based system of your entry and your exit based on your edge and what the data has proven to be profitable. And then you want to take that profitable trading plan now, because you've done testing, you know it's profitable, and dilute it down into a trading checklist. So you have a step-by-step checklist that you can have in front of you that you can make sure you tick off all the boxes to guide you into decisions when you're trading. So you don't get overwhelmed by the infinity of decisions you can make as a trader, but to ensure you stay process-based. So once you have a balanced identity, data to support your profitability, rules to guide you into wise decisions and process-based decisions, you then need a risk management protocol that will allow you to take 100 trades without blowing up. Because now you need to approximate your edge. You need to take a lot of trades over a large sample space, but you need to have a risk management protocol that allows you to do that without blowing up. And you always want to think, what would be sustainable at scale? Because the thing about making $10,000 per month, if your average return per month over a large sample space, maybe it's 5% per month on average. You may have 60% over the year, and you divide that by 12, so 5% per month on average. Some months may be higher, some months may be lower, but on average, 5% per month. To make $10,000 per month, you need to have $200,000 worth of funding. So you need to know your math in order to get you to $10,000 profit per month. But in all probability, to be hitting $10,000 per month, you need to be trading a decent amount of size. Probably at least $200,000 in funded capital, which is not difficult to get. You get a few funded accounts, you get one funded account, and you're already at 200,000. But my point here is you want to be developing a risk management protocol that you can trade at scale. And what I have found with my top performing traders in my prop firm and the successful one-on-one traders I consult for is that the golden rule is don't be risking more than 1% of your total account size. So if you have a $200,000 funded account, you don't want to be risking more than $2,000 per trade. You also want to have a daily loss rule. Make it most likely cap out at 2% per day. You don't want to be losing more than 2% per day. You want to have a daily max exposure, meaning that the total risk exposure at any point in time is 2%. The total trades open at once is max 3 trades. And you also want to have a max drawdown. Even if you're not trading a funded account, you want to have some sort of a max drawdown. This is just to ensure that you trade with good behaviors and you're not falling into gambling behaviors. And my suggestion is never go over 10% drawdown on any account, funded account or personal account. Because you want to be aiming for a max drawdown to return ratio of about never going below 10% drawdown and consistently every year hitting over 25% per annum. If you can do that, you're an exceptional trader. Now, to ensure you never blow up your funded accounts and your personal accounts, you want to also implement some sort of a drawdown protocol. Once you have the right identity, the data, the rules, the risk management protects you from getting highly emotional. And what I find is that the deeper traders go into drawdown, the more they stimulate fear and greed, increasing the probability of taking them away from their rules and their trading plan. So you want to have some sort of a drawdown protocol that helps keep your risk intact and keep your emotional state balanced so you can stay to your trading plan, even being in drawdown. And one of the best ways to do that is to reduce your risk as you go deeper into drawdown. So let's say, for example, you got a $200,000 funded account with a max drawdown of 10%. Now, at break even and beyond, if your account's at $200,000 or more, you're risking 1% of the account. So your per trade is $2,000 per trade. Now, if you go 5% into drawdown and you get your account here, which would have your account balance at 190,000, that's 5% deep into drawdown, then you want to half your risk. So instead of now risking 2K per trade, you're now risking 1K per trade. And then if you go even deeper into drawdown, you then want to half your risk again, risk $500. So the closer you're getting to the max drawdown limit, you're reducing your risk. And this just allows the amount of consecutive losses you could take to increase, to double. And this is a powerful risk management tool to ensure you protect your psychology so you can stick to your edge and not get derailed by your emotional state. Now, once you have a balanced identity, data to support your profitability, rules and proper risk management, it now becomes a game of psychology and neutrality. And really what the best traders are doing now that they have those 4 first pillars is they're doing everything they can to manage self-sabotaging behaviors. And one of the best things you can do is develop a trigger journal to identify every time you participate in a so-called self-sabotaging destructive behavior, like over trading, like over risking, like deviating from your trading plan. What was the initial trigger that triggered you into an unwanted state? Maybe you took multiple losses in a row. Maybe you were running profit and then ended up taking a loss. There's some sort of trigger that triggers you into a state of anxiety or an unwanted state that then these so-called self-sabotaging destructive behaviors are coping mechanisms for. So if you can get really good at identifying your triggers, the things that trigger you in the market, both positively and negatively, and identifying the root cause of that, just that awareness alone can help you bring more control in those situations. Because really, the goal now is having neutrality and being aware of your triggers and having ways to manage those triggers so you don't deviate from your plan. A really powerful tool that I developed is called the Bulletproof Your Trading Mindset 2.0 tool. It's a completely free tool, link in the description. And I encourage all my 6 and 7 figure traders to have this part of their pre-trade routine. What it does is it helps align them to making sure they're making process-based decisions, not emotional decisions. It takes them through a step-by-step process that asks them a series of questions to help them identify what type of decision am I making? Am I making an emotional decision or a process-based decision? And if they become aware that they're making an emotional decision, I take them through a grounding process to make that decision process-based and aligned with their trading plan. So having this tool part of your pre-trade routine allows you, again, to increase the probability of sticking to your trading plan. These two tools here, very powerful, crucial if you want to scale to $10,000 per month and sustain that. And then finally, after every trading day, having a post-trade routine, a routine that allows you to stabilize yourself. If you took a trading win that day and you're all elated, you want to remind yourself of the drawbacks of that, the risks of that, the downfalls of that, what you missed out on, what you overlooked, to humble yourself. Because if you don't humble yourself, guess what? The next trading day, you're going to come in all proud, force trades to the market, you're going to get humbled by the market. So if you're proud, puffed up, you need to humble yourself after that trading day so you don't bring it into the next. And if you're down after a loss, you need to lift yourself up, remind yourself of what you did well that day, what you didn't overlook, what you caught this time, but you didn't last time, and lift yourself back up so that you're not in a state of fear next trading day and not executing positions the market presents to you. Really, once you have the first 4 steps, the pillar in place, it becomes a game of self-management, self-regulation, neutrality, so that you can stick to the processes you've developed. Once you have these 5 characteristics, you can then open yourself up to an enormous amount of scale. Funded accounts, prop firms, private investment, hedge funds. You allow yourself, once you have the proven processes, to now leverage so you can get to $10,000 per month in payouts and much, much more.